G'day. Welcome to the Agricoach Podcast for families on the land who want to grow their family's wealth and prosperity across the generations. I'm your host, Ben Law, and I'm the financial bloke. Welcome back to the Agricoach Wealth and Wisdom Podcast, where we tackle some of the biggest challenges facing farming families, helping you build resilience, create wealth, and set up your family for long-term success. I'm your host, Ben Law, and today we're diving into two of the most important global shifts that will impact agriculture for decades to come. If you've been listening for a while, you'll remember episode number 73, where I sat down with leading economist Saul Eslake to unpack what was happening in the Australian economy. Well, he's back by popular demand, and not too soon either, with all the chaos going on around the world. Saul is one of Australia's most respected independent economists. He spent 4 decades analysing markets, shaping policy and advising institutions, from his time as a chief economist at ANZ to running his own firm. When Saul talks, smart people listen. In this episode, we're going to cover the global shockwaves from Trump's new tariffs, what that could mean for our economy and interest rates, and what is the true state of the Australian economy. Whether you're leading a multi-generational family business, making big investment calls, or simply trying to stay one step ahead of the curve, this conversation will help you think more strategically about the forces shaping your business, your family, and your future. Before we kick off, we need to keep the lawyers happy with a disclaimer. The information contained in this podcast is general in nature and is for education purposes only. It's not financial advice, it's not legal advice, and no one should act on the information without appropriate specific advice for your particular circumstances. I'm a former financial advisor, but I'm no longer licensed and cannot and will not give you specific or personal advice in this podcast. So now that we've got the lawyers happy, let's get into it. Saul Eslake, welcome back to the podcast.
Thank you, Ben. It's a pleasure to be here. I think you said before it's exactly a year since we spoke last time. I didn't realise it was that long. It seemed more recent than that, but hopefully this will be as good as last time was.
Yeah, well, I really enjoyed it last time. It was a pretty popular episode. And yeah, it's exactly 1 year to the day today since we last spoke. By luck, pure luck, Saul. And I've been watching and interest rates, and we're going to be talking about interest rates today, not straight off. But I know last year I said, I'll hold you to those predictions, Saul, jokingly. And lo and behold, you were pretty much spot on, which was good to see. And just to be clear for everyone listening, that's a very hard thing to do consistently, isn't it?
It is. And, I've made plenty of wrong forecasts about interest rates and the currency in my past. And, I'd like to think I've learned from those experiences. And so, yes, I had been saying since November 2023 that there'd be no movements in interest rates in either direction through 2024 and that we could expect a cut in February 2025. And that's what we've had so far.
Excellent. Instead of Warren Buffett, the Oracle of Omaha, we'll have to call you the Oracle of Tasmania. Awesome. Well, look, let's just get right into it, Saul. So the first thing is the number one thing on everyone's mind is what's going on in America with Trump. He's got tariffs. They're going to be on. They're going to be off. They're on China. They're on beef. They've gone all around the track. And essentially that's causing ripple effects through not only the political sphere, but also the broader economy and also the share markets. So from your point of view, Saul, can you just unpack a little bit about what's going on and how you see this playing out, especially for, say, people in the agricultural industry over the next, let's say, 12 to 18 months?
Well, that's not an easy task, Ben, because it actually is really hard to figure out exactly what Trump is doing, why he's doing it, and what the effects of it. Well, it's actually easier to figure out what the effects of it will be than to predict what he's actually doing. One important thing to remember is that part of Donald Trump's appeal to what was, as the Americans say, a plurality of the American electorate, that is not a majority, but a bigger share than anybody else got, which is why he's the president, is the perception that he does what he says he will do. And Trump has, if there's been one constant in his life, it is that he has been an advocate of tariffs. And that he believes, as quite a lot of other people do, but no one with an understanding of economics does, that tariffs are something that governments make foreigners pay to get their goods into a country. The reality, of course, as every economist knows, is that tariffs are something that governments make their own consumers pay to keep foreign goods out of a country. But Trump genuinely believes, I don't doubt him about this, that forcing Americans to pay higher prices for things imported from other countries will encourage fewer things to be imported into the United States and more things to be made in the United States. And Trump appears to have a view that if more goods could be manufactured in the United States, that people who've left school at 14 with no post-secondary education, many of whom voted for him at the last election, will be able to get the sort of jobs at the sort of pay relative to others that their fathers and grandfathers got in the 1950s, 60s and 70s. Now, it might perhaps be true that if Trump were to maintain a regime of high tariffs, that some manufacturing may come back to the United States from China or Mexico or Canada or places where manufacturing has been relocated in recent years. But if it does, that's only going to create a small number of highly skilled jobs, because more jobs have been lost in manufacturing, not just in the United States, but in all advanced economies, including Australia's, through technological change and automation, than have been lost by competition from lower cost producers, most obviously China. I mean, some obviously have. There's no disputing that. Although, let's remember in the Australian context, of course, that the relocation of manufacturing to China has created enormous demand for Australian iron ore, coal and LNG, without which we would have been struggling as an economy over the last 30 or 40 years. And the increased incomes which Chinese now earn as a result of moving out of subsistence agriculture in rural China into manufacturing and more recently services jobs in urban areas of China has created demand for products like beef and lamb and seafood and wine and barley that has been very important for Australian producers of those items. China is, if not the biggest market for most of our agricultural commodities, is certainly one of the biggest markets for our agricultural commodities, and almost all of our farmers would be poorer if China were still back where it was 40 years ago as a relatively low-income country in which the vast majority of the population subsisted on relatively small plots growing their own food.
So have we seen a time like this before, Saul? Because history, I heard someone say once, history doesn't repeat itself, but it definitely rhymes.
That was Mark Twain, the Huckleberry Finn.
Oh, there you go. So have we seen a time like this before where there's been, let's just say, substantial tariffs put on, and what actually played out over that time?
Well, yes, we have, but I should, Ben, just say something else in answer to your first question, which is the other dimension of what is happening in the United States is the chaotic, if not anarchic way in which these tariffs are being instituted. So, if you think about the sequence of events and announcements since Trump was inaugurated on the 20th of January, we've had tariffs being imposed on Mexico and Canada, and then they've been suspended. And then we've had the so-called reciprocal tariffs, which Donald Trump announced on the 2nd of April, which, range from 10% on us and the UK and on the penguins and seals on Heard and McDonald Islands and the like, through to 29% on Norfolk Island, all the way up to 54% it was going to be on China and 26% on Japan and so forth. And then, this past week, all of those tariffs have been suspended for 90 days, except for the ones on China, which have been doubled to almost 140%. And, Trump is saying that if enough foreign leaders come to Washington to, and I'm quoting him, these are not my words, kiss his ass, charming language from the President of the United States, but that's exactly what he said, that maybe these tariffs will remain suspended or maybe they will be reinstated after 90 days. I mean, the point is that no one knows. And the consequence of this is the greatest level of uncertainty about economic policy in the United States that there has been for decades. And that matters because when businesses are uncertain, they shut up. Well, they don't go out of business altogether, but they pull down the blinds and they put off making decisions about investment and employment. And when people are uncertain about whether, for example, they have a job in 6 months' time, then they put off buying major items or perhaps even going on holiday or something. So this unprecedented volume of uncertainty, the way in which Trump is implementing and then unimplementing his policies, is probably the biggest source of the risk of recession. In the United States, the JP Morgan put it 60% last weekend.
You've built a scaled, highly profitable operation you're proud of. But what will your legacy really be? If you're 5 to 15 years from succession, now's the time to step back, get clear, and design the next chapter with your family, not just for them. That's exactly what you'll do at the High Performing Families Roadmap Workshop, back this July after overwhelming demand. In 2 days off farm, you'll design your family's 10-year roadmap, align on what matters most, and set a clear plan your whole family can get behind. No fluff, no drama, just strategy, clarity, and serious progress. If you want in, head to agricoach.com.au/take action. Spots are limited. Now, let's get back to the episode. Wow, 60%.
And, although, as we know from our own experience in the last 25 years, if the US has a recession, that no longer automatically means that we will have one, as it used to. But given how weak most other economies are at the moment, including China, which has been struggling to achieve its lower growth targets in recent years, and where, as we again learned this week, inflation is negative in China, that a US recession could well result in recessions in other countries. And, frankly, if China has one, then we're likely to have one because China takes 36% of our exports, as opposed to the US only taking about 4.5% to 5% of our exports. But to go back to the second question that you just asked, has there been a period like this before? Yes, unfortunately, there have been. And the one that most readily comes to mind, of course, is the so-called Smoot-Hawley tariffs that were introduced in 1930, not long after the great crash of 1929, which most people regard as initiating what we now come to know as the Great Depression. The Smoot-Hawley tariffs certainly helped put the great into the Great Depression. They didn't cause it. It had started before then, and the Great Depression had other causes apart from the stock market crash of October 29. It includes mismanagement of circumstances very similar to the global financial crisis of 15 years ago that the Fed, the central bank in the United States, completely botched. And indeed, one of the reasons why the Federal Reserve under Ben Bernanke did all the things that it did during the financial crisis of 2008-9 was because Ben Bernanke's academic career before he became the head of the Federal Reserve had been based on studying the mistakes that the Federal Reserve made in the 1930s, which helped deepen the Great Depression. And Benjamin Bernanke, when he was on the Fed board, but before he became chairman of the Fed, actually promised Milton Friedman, who had also made his economic career at the beginning analysing the mistakes that the Fed made in the Great Depression. He promised Milton Friedman on his 90th birthday that they would not make those mistakes again. And he was in a position to keep his promise to Friedman when he became chairman of the Federal Reserve just before the onset of the financial crisis. But those tariffs, the Smoot-Hawley tariffs that were imposed by the US in 1930 and which were copied by other governments in the so-called tit-for-tat retaliation, they certainly put the great into the Great Depression. And one of the lessons that the United States took out of that when it built the post-war order, the so-called rules-based international order, which Donald Trump is now tearing down, one of the lessons which the US learnt from that is the damage that was caused by all of those tariffs which turned some of countries like Japan, which had been an ally of the West in the First World War. And most Australians probably don't know that the ships which took their grandparents, including my grandfather, to the Middle East and ultimately to fight in Gallipoli, were escorted across the Indian Ocean, where German ships were lurking, were escorted by destroyers and warships from the Imperial Japanese Navy. But the tariffs and other trade measures which the United States and others imposed on Japan in the 20s and 30s helped turn Japan into an enemy, which we learned to our great cost, of course, in the 1940s, when Japan tried to thought about invading Australia and came very close to doing so. So in the post-war era, the US learnt the lessons of that period and gradually, over the following 50 years, steered the world to a very low tariff regime, partly by its own example, partly by encouraging other countries, including Australia, to abandon protectionist trade regimes, and Australia was one of the major beneficiaries of the movement towards freer trade. It was never absolutely free, but freer trade around the world. Donald Trump is now trashing that. And while I think it would be an exaggeration to say what Trump is doing is going to precipitate another Great Depression, I think it's highly likely that what he's doing and the way in which he's doing it will trigger a completely unnecessary recession in the United States. And that could in turn, especially if it's compounded by similar measures taken by other governments in response to what Trump is doing, that could well trigger a global recession as well. And it would be one, to invert Paul Keating's notorious phrase, that we did not have to have.
Yeah, it's interesting, isn't it? It's like you really, really clearly articulated at the beginning is if you knew the tariffs were going to go in place, you could look at this fairly objectively and say, okay, what's the next level? What's going to happen? What's the next event to occur? You know, the follow the bouncy ball. But in this case, like you said, he could turn around tomorrow and not have it. Have we ever seen any leaders from a presidential point of view that have been so erratic in these decision makings?
Well, I can think of one recent example, Ben, and some of your listeners will recall this when I mentioned that in 1923, when the British Conservative Party finally decided to get rid of Boris Johnson, he was replaced by a woman called Liz Truss. And she and her Chancellor Kwarteng introduced a budget that included billions of pounds of unfunded tax cuts. And there was a complete upheaval in the bond market, which would have been expected to fund the borrowings required to pay for those tax cuts. Interest rates went through the roof. The gilt market, as it's called in the UK, melted down, and the Bank of England had to step in to stage an almighty rescue. And the British Conservative Party woke up to themselves. Liz Truss resigned and was replaced by Rishi Sunak, who, of course, lost the election last year to Sir Keir Starmer's Labour Party. The newspapers made the point that Liz Truss lasted less time in number 10 Downing Street than a warm lettuce normally lasts on a supermarket shelf. So that's an example. And we actually came very close to that in the US bond market last week. The reason why Trump backed down from his so-called Liberation Day reciprocal tariffs was that there was a massive sell-off in the US Treasury bond market, which risked putting the US in a position where it could not finance its budget deficit. And that was actually a very interesting aspect of the market reaction to Trump's policies and the way in which they're being implemented. I think everybody knows there had been this massive sell-off in stocks, that at one point the day before Trump's backflip, stocks were down, I think, by about 18% in the United States from their peak. It was getting close to bear market territory. What normally happens when there is profound uncertainty about the economic outlook or the financial outlook, as we saw during the financial crisis of 2008-9, and as we saw during the first month of COVID in March 2020, when there is enormous uncertainty, one of the things that almost always happens is that the US dollar goes up and US Treasury bond yields go down, because US dollars and US Treasury bonds are seen as one of the ultimate safe havens, a bit like gold. And yet what we saw this time was the US dollar going down and US Treasury bond yields going up. Now, what that tells you is that one of the different ways in which America under Donald Trump is trashing its brand, and I think that's the greatest damage, that what the Trump regime is doing is trashing America's brand, the respect or even affection with which many people, including many Australians, think about the United States, not only because of the role they played in defending us in World War II, but the role that America has played in entertainment and product innovation. You know, there's a reservoir of affection or respect for America that I think Donald Trump is trashing. But one particular aspect of it that's relevant to the conversation we're having is that America has trashed its brand as a safe haven. And so, during this period of enormous uncertainty, the bond market that is normally where people put their money when they're frightened was in fact melting down as well. And I think it was that realization which Trump probably didn't understand until it was brought home to him by Scott Bessent, the Treasury Secretary who has a background dealing in the bond market, brought that home to him, that Trump agreed to back down. But then, the message that flows from that is that if Trump is going to back down in the face of financial market meltdown, how confident can anyone who might otherwise have been encouraged to build a boot factory in the United States rather than source imports of boots from Vietnam, how confident can you be about making a decision that could take 5 years to come to fruition to build a new factory and get it operating? How confident can you be that the tariffs which Trump is proposing to protect you from competition from Vietnam will actually still be there if, as Trump has said, the secretary of the Communist Party of Vietnam who runs Vietnam gets on a plane and agrees to give Trump what he wants? How can you possibly make a decision in those circumstances? And that's what people around the world, not just in the United States, are now trying to grapple with.
Everyone freezes in their decision making. So one of my favourite movies, Saul, is The Big Short. I remember I've watched that a number of times, and I think I loved it so much because I understood everything that was going on, but I also liked it so much because I just went, how has this ever happened? And, you look at most of these big events, what's the sleeping giant here that we don't know about within the markets, that Trump's uncertainty that could trigger something like the GFC? Is there over leverage in certain markets? What are you seeing out there?
Well, you mentioned leverage, and that's certainly a source of potentially significant risk. I mean, what we know from the financial crisis and from that brief meltdown that occurred at the beginning of the COVID pandemic is that when there's a significant volume of highly leveraged investment into particular assets, and for whatever reason, the market for those assets frees up, as a result of which people who have taken out leveraged investments face what we know are called margin calls. That is, the lenders want some of their money back. In those circumstances, you don't sell what you should, that is to say, the assets which you bought with the borrowed money. You sell what you can, which is, as it was during this past week, US Treasury bonds. You sell them rather than buy them. And that's how contagion happens from seemingly unrelated markets. We saw this in the financial crisis of 2007 through 9, which started in the market for mortgage-backed securities and what, if you remember, were called collateralized debt obligations or CDOs. And, that market froze up. People who borrowed money to buy mortgage-backed securities or CDOs and were then getting margin calls from their banks say, well, I can't sell the CDOs, I can't sell the mortgage-backed securities. The only thing I've got are US stocks or US Treasury bonds, so I sell those. Now, one potential source of risk in these circumstances might be cryptocurrencies, right? Bitcoin, you'll remember, rallied up to over $100,000. Maybe not by coincidence. Bitcoin peaked the day after Trump's inauguration when Trump issued that meme coin, and his wife followed pretty soon afterwards. What's happened to Bitcoin since? Its price has dropped to, I think, about 76,000. It bumped up to over 80, and then it's come down again to below 80,000. Nobody knows to what extent people who've piled into Bitcoin and other cryptocurrencies have done so with borrowed money. But if they have, and Bitcoin and other cryptos will continue to melt down, people wouldn't be selling them to pay back their margin calls, they'd be selling back. So there's one significant risk, is just of contagion between seemingly uncorrelated assets where the linking factor is actually leverage or debt. That's one. Here's another one that may not happen, but is worth thinking about. For China, in the face of what Trump is seeking to do to China, the nuclear option would be to sell some, or maybe all, of the more than $1 trillion US dollars of US Treasury bonds which China has accumulated over the last 30 or more years. Now, they may well have considerably in excess of $1 trillion US dollars, because it's known that the People's Bank of China isn't the only place where China holds US Treasury bonds. It holds quite a lot through nominee companies in places like Luxembourg and Belgium, the Cayman Islands and Bermuda. As a lot of other investors do, hold their investments in shares through nominee companies rather than disclosing them outright. And China has accumulated all these US dollars because although it's running big surpluses, which would normally mean that the demand for renminbi, the Chinese currency, from exporters who want to convert the US dollars they've earned into renminbi so they can pay their workers and record their profits and so forth. The demand for renminbi from Chinese exporters is much greater than the demand for foreign currency from importers into China. So what the Chinese central bank has been doing for decades is buying US dollars. You're printing renminbi and buying US dollars in order to keep the renminbi stable rather than from going up. So they're sitting on an enormous pile of US dollars. At least in theory, the Chinese could retaliate against what the US is seeking to do to China, by putting huge tariffs on them, not by putting huge tariffs on what China imports from the US, because China doesn't import much from the US, but instead by selling these treasury bonds. What would that do? It would put downward pressure on the US dollar. It would put significant upward pressure on yields on treasury bonds, which not only would make financing its deficit more expensive for the US government, but remember also that most Americans who are home buyers have mortgages which are at fixed rates for 30 years, and the rates on those mortgages are set by reference to US treasury bonds. Most American companies, particularly big companies, but often quite small companies as well, don't borrow directly from banks but issue corporate bonds. The yields on those bonds price at margins over US treasuries. So China could in effect impose significant increases in interest rates on the US government, on US corporates and US home buyers by selling out of its $1 trillion plus pile of US treasuries. The risk for China, of course, is that in order to do that, their currency would go up a lot. And that would further undermine the competitiveness of their exports. That's why I say it's a nuclear option. The thing that stopped the Cold War degenerating into a nuclear war, which people say it almost did during the Cuban Missile Crisis of 1962-3, was the fear that both the Russians and the Americans had that if they launched a nuclear missile, there'd be one coming back the other way before you could print the full stop at the end of the order to fire a nuclear missile. So, the Chinese have to be aware of that in that conscience. But if they were to start doing it, that could be the trigger for another global financial crisis because of the importance of US Treasury bonds as setting interest rates for the whole world.
So simply put, China, there's about $35 trillion. So China owns over $1 trillion worth of that US debt. They could then go out and sell those bonds, which essentially means the US economy would be tanking. Interest rates would be heading up. That would be sort of what they call a stagflation type of environment. Would that be right?
Well, yeah. That's the sort of thing that could perhaps precipitate something that came close to the Great Depression. Now, probably not that, because I think there would be an awareness on the part of other governments as to what to do when faced with that. The financial crisis of 2008-9 could have turned into a Great Depression if governments and central banks hadn't did what they did in response to it. And they did what they did in response to it because they learned the lessons from the mistakes they made in the 1930s. So, governments you kind of wonder whether the Trump administration has learned any lessons from history. But governments in other parts of the world where a higher level of sanity appears to prevail, probably would learn those lessons and hopefully would apply them, including our government here in Australia at our central bank.
So before we get on interest rates, because I want to go down there, I like to be a realist, but I also like to look through an optimistic lens. From your point of view, looking at what's happening around the world, what's the positives out there? What's the positive story that could come out of all this uncertainty?
That's a very difficult question to answer in these circumstances, because we're talking about the sheer madness of economic policy making in what is still the most important country in the world, and one which most Australians regard as a friend of Australia, not just economically or militarily, but in a whole lot of ways. This is a bit like seeing your best friend make terrible life choices, to go on drugs or to self-harm in some way. And, if you've ever been in that situation where one of your best mates that you've known for a long time is doing things that are bad for him, but there's nothing you can do to stop him doing. That's the sort of feeling I have in some ways about what America is now doing to itself, as well as doing to the rest of the world. And in that context, it's important to remember that Donald Trump is where he is today, and the people who are around him are where they are today because a plurality of the American people put him there. Knowing what he would be like, which arguably they didn't in 2016 when they elected him the first time. And what that tells you, what I think people around the world, including Australia, need to understand, is that the American people of today are not the same as the American people of 80 years ago who saved the world from fascism, or the American people who over the following 45 years stared down Soviet communism. They're not the same people on whose behalf John F. Kennedy pledged in his inaugural speech in 1961 to bear any burden and pay any price in defence of liberty. They're not even the same people on whose behalf Ronald Reagan, the opposite of the political spectrum from John F. Kennedy, Ronald Reagan stood in front of the Brandenburg Gate in Berlin and said, "Mr. Gorbachev, tear down that wall." The American people of today want walls built to keep out foreign goods, tariffs, foreign people, migrants, and foreign ideas. And they're not the American people that, we in Australia, among others, have come to know and love. Since, for better or worse, sometimes we have a love-hate relationship with America, but it's overwhelmingly positive. That isn't there anymore. And that, I think, is going to take time for Australians and similar people in Europe and Canada and Japan and Korea and Singapore to come to terms with and think about what it means. We, I think, in conjunction with the allies we can trust, Japan, Korea, Singapore, Canada, Europe, have to build a new way of working that goes around the United States and makes us less vulnerable to the kind of country that unfortunately America is becoming or has already become. We need to think about how do we work together to ensure our own security, bearing in mind that we might not want to import the kit we require for our own security from the United States because, as the British are discovering, might have kill switches in it that prevent us using it in ways the Americans don't want us using it. Can we source defence equipment from countries that we can actually trust and rely on? Can we form free trade agreements with, in particular, Europe that we've not been able to, and free trade agreements that are worth the paper they're written on, unlike the ones we have with the US and China that have been torn up by those governments on different occasions in the last 5 years? There's an awful lot of hard thinking to be. Now, it's possible that just as out of the terrible tragedies that were the Great Depression and then the Second World War, a better world emerged, it's possible that a better world will emerge out of the chaos that's happening around the world at the moment, but it's going to take a while.
It's interesting. The world came out of the Great Depression and then into the Second World War and then out of the Second World War because it was driven by people of strong character. I interviewed John Anderson a couple of weeks ago, ex-Deputy PM. The podcast came out today, actually. And we talked about the fact that strong character is what we need leading forward, and that's what seems to be lacking around the world. And for me, Saul, the big light at the end of the tunnel for me, if I have to look through an optimistic lens, and I'm not suggesting the world is all rosy and shiny, but Trump is a capitalist. And I think that what I would hope is that, like with the bond market, he sees the impacts of these issues short term, and therefore we can avoid any calamities coming through. He can change course. The people around him can point those out, and his desire to win at all costs will be the things that keeps the markets, keeps the economies moving forward, because I think he will, and not saying he can, but I think his drive will be to make sure when he gets out the end of the 4 years as president that things will look rosy at that stage economically. So I'm pinning my hopes on that.
I wish I could share that optimism, Ben, but let's remember the people who are around Mr. Trump today, unlike the ones who were around him in his first administration, the people who are around Mr. Trump today are there because they answered the question that was put to all of them, who won the election in November 2020. They answered it in the way that Donald Trump wanted it to be answered. That's why they're there. That was a loyalty test that everyone who is around the president today had to pass. They had to demonstrate they were willing to lie, to tell an untruth, in order to demonstrate their loyalty to one man. I find that frightening. I really do find it frightening that these are the people, with their fingers on the nuclear buttons, who are advising, what is the leader of what is still the most powerful and important country in the world. And as I say, I understand why you want to look for silver linings. Maybe for me, the silver lining is that Australia will eventually find the means to think for itself and to create our own place in our part of the world and in the world more broadly, one that we can identify as being uniquely Australian rather than being dictated to by our great and powerful friends, as has really been the case since 1900.
Yeah, I totally agree on that point. And then we find our character and our Australian spirit back again, which is, I think, has been severely lacking. So, Saul, on that, the positive for Australia is interest rates and how our economy is going. Now, could you run us through, because we've got an election coming up shortly when we're recording this. Politicians like to tell you the economy is going well, but I think everyone on the street, people I talk to, those that are doing well, those that aren't, are all feeling the pressure of the, as they're calling it, the cost of living crisis, but it's really the induced inflation problem we've got. How is the Australian economy actually faring at the moment? Not trying to look too much into the future as to what's happening with Trump, but how is it actually faring at the moment? And notwithstanding a cataclysm happening in the markets overseas or a Trump effect, where do you see interest rates going in the next couple of years? Because everyone that's listening here in the rural industry generally have a good lick of debt. And so any reduction in interest rates are very, very much welcome. So how's the Australian economy looking? And what do you think we're going to see out of interest rates over the next couple of years? Because we're starting to see those fixed rates coming down just a smidge at the moment.
So I would say, obviously, as your question implied, and as all your listeners know, the Australian economy has been through a tough patch. We haven't had a recession in the conventional sense of that word, in the way that we did in the early 1990s and in the early 1980s. We haven't had that. And sometimes, like the curious incident of the dog in the night in the Sherlock Holmes stories, the fact that something bad hasn't happened, you don't get much recognition for that. Whereas, of course, if something bad happens and you happen to be, the guy on the bridge at the time, then it will be your fault and you'll cop the blame for it. But, while we've avoided recession, ordinary Australians have seen the biggest decline in their material living standards in at least 60 years. Real household disposable income per capita fell from a slightly artificially inflated peak in the third quarter of 2021 to its trough in the June or second quarter of 2024, fell by 10%. That's a bigger fall than has occurred during recessions or at any period since this data started in the second half of 1959. It happened for, broadly speaking, three reasons. One, because for about 2 or 3 years, wages failed to keep pace with the big increase, failed to keep pace, I should say, with a big increase in prices, much of which was of global rather than domestic origin. Now, that isn't necessarily an issue for farmers, but for people working, they're earning a wage, unlike some other countries like the US, New Zealand, the UK, where wages were part of the inflation that those countries experienced. Here, it really wasn't. And that's in large part because of the prevalence here of multi-year enterprise bargains that determine the wages and salaries of about 2/3 of the workforce. So the first thing was that real wages fell a lot. The second thing, of course, was that interest rates went up a lot. And although there are some people who benefit from higher interest rates, if they're retired, if they own their own homes and they've got money on term deposits, they'd be a bit better off. The reality is that those Australians who do have debt have so much of it. And unlike the US or the UK or Canada, it's almost all at floating rates. So when the Reserve Bank whacks rates up, they feel a hit from it. And that was a big hit. And the third thing, of course, was the ongoing impact of bracket creep. The proportion of personal income being taken in tax, whether you're a farmer or a wage and salary earner, that was the highest it had been in more than 25 years. And so all those three things combined to produce, as I say, a real squeeze on the living standards of everyone under the age of 65. People over the age of 65, although they're often not normally well off, they've usually paid off their home. So they're not affected by higher interest rates or rising rents. And if they're on the pension, their pension is fully indexed for movements in the CPI. So, I'm not saying they're comfortable.
And their term deposits and shares have gone up in value.
Yeah, and until recently, their shares will have gone up in value as well. Yes. So while they're not necessarily living on the hog, they didn't experience a cost of living crisis in the way that younger workers with children and with big mortgages absolutely did. That is now starting to fade. Inflation has come down to less than 3%. It's still a bit higher than the Reserve Bank wants it to be, but low enough for the Reserve Bank to have felt comfortable starting to cut interest rates. And also because inflation has come down, people getting wage increases, even if they're only 3 and a bit %, which is the average now, that's actually at least ahead of inflation rather than, less than half of inflation as it had been in 2022 and 2023.
Treading water.
Yeah. And, there have been some tax cuts. Everyone got a tax cut on 1 July last year. It wasn't a big one, but remember that people earning less than $50,000 wouldn't have got anything if the government hadn't restructured those. And although, it's not very much, there'll be some small tax cuts in July 26 and July 27 if the current government is re-elected. If it isn't, well, you won't get those tax cuts, but you'll get cheaper petrol for 6 months. And in rural and regional areas where there isn't public transport and where the distances are longer and the fuel is more expensive, then, that's probably a positive as well. The other thing that tends to get downplayed is that we've sort of won the battle against inflation, not completely, but we're about 90% of the way there, without a big rise in unemployment. The unemployment rate is still low by historical standards, and it rose by about 0.5 percentage point from its lowest point in 2022 before the Reserve Bank started putting rates up. And that increase in unemployment of just 0.6 percentage points compares with increases of 1.9 in Canada and New Zealand. And the increase in New Zealand would have been higher, except that Kiwis can come here to look for a job, which, we can go the other way, but it doesn't normally happen. But the last two battles Australia had against inflation in the early 90s and in the early 80s, they were accompanied by increases in the unemployment rate of more than 5 percentage points. 10 times as big as we've had this time. Now, although we're all supposed to be concerned about unemployment, the reality is that the only people who are concerned about unemployment are the people who become unemployed or the people who think that they might be. And that's been a very small proportion of the population compared with the early 90s and the early 80s when the unemployment rate got up to above 10%. But again, like the curious incident of the dog in the night, because it didn't happen, nobody gets the credit for it not happening. And so I think that's an important thing to bear in mind. If it weren't for the chaos that's now happening globally, I would say the outlook would be for a gradual improvement in economic growth and in living standards, and for interest rates to continue to come down. We could get a more rapid improvement in our living standards if whoever is in government, whether it's Labor or coalition, were going to do things that would sustainably lift productivity. Because productivity, what you produce for what you put in by way of hours worked, is, as almost every economist says, ultimately the only sustainable source of improvements in material living standards. And the reason why Australian living standards have been stagnating for the last 10 years is because productivity has been going nowhere for the last 10 years. Now, Australia's not Robinson Crusoe in that respect. In almost every other advanced economy, with the conspicuous exception of the United States, productivity has been walking sideways. And so living standards have been stagnating in other countries, and that's why, at least until this year, incumbent governments, whether they've been right-wing governments like Rishi Sunak's in the UK or left-leaning governments like Joe Biden's in the United States, whoever's been in charge has lost, because the public has voted with their feet against the stagnation in their living standards. Now, in Canada and Australia, because of Donald Trump, it might be different than it has been in other countries which have had elections in the last 18 months or so. But to come back to the other part of your question about interest rates, I certainly expect the Reserve Bank to cut the cash rate at its next meeting on the 19th and 20th of May. And that they will do that because the CPI figures that come out on the 30th of April will show that the underlying inflation rate, that's the one that the Reserve Bank cares about, that they're looking through the impact of electricity bill rebates and other things that governments do, and also, fluctuations in things like petrol prices. They look through that. The underlying inflation rate will be 2 point something. It was 3.2 over the year to the December quarter, which was just before their February meeting at which they cut rates. And it will be 2 point something over the year to the March quarter. And that will give them sufficient reason to cut rates again. They probably will cut rates again in August. But I say probably rather than almost certainly, as I do with regard to May, because there's a lot of unknowns that are now out there. In particular, tariffs push prices up. Our currency going down, which it's been doing, push prices up. And if some combination of tariffs and a weaker currency interrupts the downward direction in inflation, which we're now seeing, then the Reserve Bank might feel more hesitant about cutting rates again. On the other hand, as economists always say, if what Trump is doing results in weaker economic growth, and certainly if it results in a recession in the US and around the world, including here, then the Reserve Bank will cut rates by more. But I think one of the lessons the Reserve Bank might learn out of the financial crisis and the COVID experience is that the main effect of cutting rates aggressively in response to an external shock is to reignite the housing boom. And so, from the perspective of people with mortgages who are buying homes, you might win on the interest rate swing and lose on the house price roundabout. If you're a farmer with an established family business, you might not care about that because you're not looking to buy a house. You just want interest rates to come down, and they will come down a bit. They'll come down more if there is a US recession. But I wouldn't necessarily bet the ranch on rates falling to 2 point something by early next year. If we are facing a recession, while we'll get lower interest rates, I think it would be more effective and sensible for our governments to do some of the things that they did in response to the financial crisis and COVID, that is, to send out cash to people that they can spend to keep businesses afloat, to maybe do some worthwhile infrastructure projects that they wouldn't otherwise do. I would hope that whatever they do is better targeted so that it doesn't go to people who don't need it. I mean, to give you an example of that, for historical reasons, I've got 2 electricity meters on my property here, so I've got 2 lots of rebates. Every time a rebate, I don't need it. I'm not going to object to having it, but I shouldn't be getting it at all, let alone getting 2 of them each time. So hopefully whatever governments do in that respect will be better targeted than these measures will be. But I think it's probably better if more of the response to a US recession, if that's what happens, comes through what economists call fiscal or budgetary policy, rather than expecting the Reserve Bank to do all of the heavy lifting, because we know from history that big cuts in interest rates result in big increases in housing prices, and housing is already too expensive in Australia. I don't think we want to go much further down that path.
Well, it's a short-term comfort creates long-term suffering, and especially for the next generation trying to buy their first home. And that's one of the things that I think, this is outside the discussion for today, but we should seriously be spending some time as a country on is trying to find to make housing affordable, because when housing's affordable, people have more money to be able to spend on other things.
On all sorts of other things, yeah, that's right. And, it for a long time has surprised me that there isn't more genuine anger among younger people about the way in which the housing system has been, probably not intentionally, but nonetheless effectively rigged by their parents' and grandparents' generation against their interests, and that people can't do today in their 20s what I did in my 20s. When I was in my 20s, I had a job. I wasn't earning a big wage, but I was able to buy a home at the age of 24. And you can't do that now unless you've got really rich parents, and it shouldn't be that way.
And I think that's what's going to bring us undone long term is as the younger people start to come through and do get angry, which I think they should be angry, and I think we should be angry that we've essentially done it to them, and they start to get into positions of power, that's where things will change. But if we don't make a change now to try and help the younger people out, we're in all sorts of strife. And I think we have a moral obligation, Saul, to do that. I mean, you mentioned before that what was the speech you said were given to the Americans was we've got to do whatever we can to defend the liberal world order?
To bear any burden and pay any price in defence of liberty. That was John F. Kennedy.
And I think the future of our community is the next generation. I mean, they're the ones that are going to look after us when they're old. They're the ones that are going to drive the economy forward. And if we keep putting them in a lose position, I mean, it's no wonder they're not buying houses. A lot of them are checking out and they're not having children. I mean, one of the things I talked with John Anderson about was the population bomb.
You just look at the United States. You look at the United States and you see angry people vote for people like Donald Trump.
Well, they vote for change. They vote for something that's going to shake the system up because the system's not working. And I can see that happening. So just to go back and tie this off, so you're putting your money on, you reckon, a May reduction in rates?
Just of a quarter. I mean, there are a couple of people who are forecasting a 50 basis point rate reduction. I don't see that. I think it'll be a quarter of a percentage point, 25 basis points, as they say. And, better than 50. I'd put the odds on that of being over 90%. Slightly better than 50-50 on another 25 basis point rate reduction in August. After that, I think it's pretty murky. Could be more, probably more, but I wouldn't bet the ranch on it.
Yeah, I think that's fairly sage advice. And who knows what will happen overseas. But the reality is if the world does go into recession, we'll see interest rates most likely come down anyhow. Maybe not as far as we saw them in the GFC or when COVID came on.
Certainly not during COVID.
No, definitely not. So look, Saul, that's a world of information. I love it. I could have a conversation about many of those topics for a full day with you. It's fascinating. And I think for anyone listening out there, you might not have understood all the things that were talked about. There's probably some stuff that's missing, but overall, there's a lot of uncertainty going on. And what would be your piece of advice to someone out there at the moment looking through this lens? What's the mindset we need to be going into the next 12 months worth of life with, Saul?
The first thing, I guess, at the risk of sounding, like a cartoon character, is don't panic. Is don't make panic decisions. Some of the worst decisions that I know people have made in recent years have been to sell after a big fall. People did that during the financial crisis. People did it during COVID. I feel sorry for those people who were encouraged by the government of the day to take money out of their superannuation, after the markets had fallen. And, that was a very financially costly decision. So if you can, don't panic, think long term, look for opportunities. The markets always move too far in one direction or the other. And, if people you trust start to tell you that markets have gone too far, they've priced in too much bad news, there are opportunities, don't dive in head first and down to your feet. Wade in carefully, but look for those kind of opportunities. Be careful of doing anything with a large amount of borrowed money, and seek out and listen to good advice.
Perfect, Saul. Thank you very much, mate. That was overly enlightening, I have to say.
Yeah, my pleasure. Enjoyed doing it.
Yeah, fantastic, Saul. Thanks very much for today. I know I learned a lot. Everyone else is going to learn a lot, and we'll be back to check how the interest rate predictions went.
All right. Good, man. Thanks.
Well, I thoroughly enjoyed that, if you couldn't tell. Being an economist by trade, I always love having these conversations, and I could dig into them for days. Now, before you go, just a couple of things. The first thing is with so much volatility and the fact that interest rates are moving and inflation is normalizing, now's probably a good time to go talk to your professional advisors, your people in your team, about what you're going to do about your interest rates and your borrowing levels at this point in time. Get professional advice, get ahead of the curve and do that. The second thing is if you're investing, markets are volatile at the moment. You've probably seen that. You want to be sure you analyze what makes sense for you, check your leverage rates, how leveraged you are with your investments, and make sure you're not making knee-jerk reactions, because markets can act very, very irrationally and then very rationally very quickly. So you want to be making sure you're making good, solid, long-term decisions around your investments that you have. Now, before you go, I just want to say thank you to everyone for listening. What I'd love you to do is, if you enjoyed the podcast, make sure you share it with your family and friends. But above all, if you could go on to Apple Podcasts, if you listen through Apple, and also Spotify, and if you could make sure you subscribe or follow us, that allows the podcast to get out to more people and share more of the wealth and wisdom. So that's it for this week. I'll see you for the next one.